the markets were just going crazy. And and I think that when you look at valuations now, people go, this can't get crazier. And then when I look at these three people and I go, yes, it can. So it becomes this reflexive feedback loop because the more shares you buy, the more you push the stock up, which means that you have to buy even more shares of stock to maintain your hedges. And so this is the essence of the squeeze. And this is something that we've really seen in Tesla. If the VIX, like it did, it went from 20 to 14, guess what? Stock market's probably going up. And that's a result of flows, right? Nothing fundamental about it, just flows. And the bigger the options market gets, right, the more this volume increases, the more hedging flows associated with all this.
Welcome to the OpEx Effect, a joint podcast from Excess Returns and Spot Gamma, where we take a deep dive into the world of options and the flows they generate in the markets. Join Brent Kachuba and Jack Forehand every month on Options Expiration Week as they look at the major developments in the options world and how they impact all of our portfolios.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Volatility Capital.
So, Brent, I think it would be fair to say things are going well in markets, you would say?
Markets are up. Things are getting memey, I guess I would say. We were joking about Scottie Pippen entering the Bitcoin arena now. There's been an appearance of Cathie Wood and Elon Musk and stuff. So yeah, we're in beginnings of meme mania, I think.
Yeah, and it's always hard to tell where, and we're going to talk about a little bit about this as we go, but it's very hard to tell how long meme mania will last. We've had some in the past, and they, they can go for a long time, they can go for a short time. Sometimes it's hard to tell.
Yes, and the thing that I think of now is the famous George Soros quote, when he sees a bubble, he rushes in to buy. And that kind of feels like we're at the blowing bubble phase, but we'll see as we march forward here. But there's a lot of interesting signs out there as we're going to find out in the options market. A bunch of interesting things percolating here. It's the end of the year.
And even my value stocks are getting involved. And when they're getting involved, things must be getting really crazy.
That's what you said. So I wish you well. We were joking that for the first time in 20 years, maybe value stocks will start to work. But maybe your hopes will be dashed by next week. Oh, fucking God. I'm pulling for you.
I'm pulling for myself as well. But so one thing that we tried to do with this podcast is we really wanted to explain, flows are such a huge part of what goes on in the markets. And for long-term investors, I think many of them, including myself, don't really appreciate how important flows are. And so we wanted to use this podcast to help people understand what they're seeing in the market and what the flows are that are driving what they're seeing. And we have two really good examples right now, probably more so than we've had in any other episode to discuss this. We have obviously what's going on with Tesla and things have been getting pretty riled up there with Tesla. And we also have the election. And we've talked a lot in previous episodes about the election and about hedging into the election and about what that can lead to after the election. So we're going to dig into both of those today, and you have some great charts behind the scenes so we can see what's actually happening and people can better understand why they're seeing what they're seeing.
Yes, and to your point on fundamental stocks, my position is that flows over fundamentals, and I guess if you have a 20-year view on something, then maybe you want to change that perspective a little bit. But the options market and the rush into the Trump memes as soon as Trump was elected kind of shows us that, right? I mean, a lot of these names, like you mentioned, Tesla's up 25, 30% in the 2, 3, 4 days after the election. And some of these other kind of themes that Trump seems to be standing for really, we just gas those returns. And some of the things you against, like you look at a chart of General Mills, which is a sugar stock, they sell a lot of junk food. That stock can't catch a bid now, which is, a Bobby Kennedy thing. So people are really entrenching themselves in these Trump themes, backing this idea of, flows over fundamentals, at least in the short term.
Yeah, you can argue, and it's actually true that, in recent years, we've been seeing this prominence of flows over fundamentals much more than we've seen in the past. But even and I'm a big believer in fundamentals, but even for those of us that are believers in fundamentals, we have to understand that fundamentals in a large part are important because they lead to flows. Like if people believe in fundamentals, their flows are then based on the fundamentals, and you see it translated in the market. And maybe you've been seeing a little bit less of that in recent years. You've seen a little more of a flows dominated market where people don't care as much about the fundamentals.
Yeah, and I think that the thing that ties into that is we spent a lot of time talking about the Nvidia options complex. I think that was in our September OpEx conversation. The idea or the TLDR of that is that there's not that much underlying liquidity left, but there's a lot of dollars floating around demanding sort of Nvidia shares, right? So you think about passive investing and indexing and all these new ETFs and individual holders in their 401ks and all that kind of stuff. is there actually that much underlying liquidity left? And then you slap on top of that all these options positions, which create hedging demand for underlying shares, and just the idea that it creates almost like a scarcity in some ways. That I think can be a real driver of things here. So it's a very interesting dynamic, that I think this is a trend that's going to continue over time, because that underlying liquidity may continue to dissipate as well as options growth, continuing that. It just, may kind of break the link between fundamentals and stock values, or reset them.
And one of the things I realized, when you realize how important these option flows are in terms of what drives the market on a day-to-day basis, the other thing you realize is as more and more people use these options, it becomes even more important. And that's what this first slide gets at, is this idea that way more people are using options now than used to.
Yeah, the growth is, that's a convex chart that you're looking there. It's it's just this hyper growth that we're seeing, driven now by, a large part by zero DTE and short dated options. That's not the entire story. You can see it longer dated growth. And, the rumors are they want to increase to daily options in their single stock side. And, we see growth from international investors coming into U.S. markets. And so, look, this is a theme. I don't think you want to short options volume anytime in the near term. As the growth just keeps accelerating, and it's coming from a bunch of different sides, right? Like put buying, call buying, indexes, single stocks, like it's all really increasing.
So on this next slide, this is a good opportunity to talk about Tesla, because this is something we talked about with GameStop in the past and with Tesla now. But first of all, it would be fair to say that a lot of what's going on with Tesla right now is options-driven flows, correct?
I firmly believe that. In fact, on Friday, we saw 4.8 million Tesla calls trade. That was the most since early 2020. And that is it's an obscene number of calls traded. And so, that volume coincided with, I think, a 15% rise on Friday. So, you see the most volatility in the days when the most options contracts are trading. Those two are very highly linked. And so, there's a lot of evidence, statistical evidence that supports, more call buying with higher upside volatility in stocks.
Can you use this slide to sort of explain what's going on behind the scenes? Because this does a really good job of explaining what's happening and maybe relate that to Tesla, to what we're seeing now.
Yeah. So in this chart here, we have AMC calls, but we're going to talk about Tesla here because it's, just replacing the stock name here. All memes trade the same way. So what happens is there's 17 different options exchanges. I believe that's the latest number. There's soon to be 18. And so what happens is when you or I were on our E-Trade or IB or whatever our platform is, and we go out and we buy some calls, that goes down to the options exchanges, and 90% of the order flow traded on the exchanges is done by market makers. And so what happens is when we each go through and we're buying a small amount of call contracts, right? In this case, it's 10 Tesla calls or 10 AMC calls. That exposure that the market makers have starts to increase rapidly, right? Because they don't know ahead of time that this order flow is going to come in. They just suddenly start getting hit, right? They start selling you calls, they start selling me calls, they start selling everyone else on Wall Street Bets or Twitter or whatever else it is. And then on top of that, you have institutional buyers as well, which can get bigger chunk of your position. So what happens is everyone buys small lots, like 10 lots, but then suddenly that exposure can increase rather sharply. And the market makers are sitting there saying, oh, we're now short a whole bunch of calls, in this case, 100,000 calls. And so if the stock starts to go up, those calls, which they're short, they'll start to lose money as a result of that position, right? Because if you're short calls and the stock goes up, your P&L is going down, right? You're losing money. So the way that you would hedge in theory is by buying the underlying stock. And not only that, you have to buy more stock as the stock continues to go up to maintain your hedge profile. And so this is what we call a gamma squeeze, right? Because gamma measures how much stock you have to buy as the underlying goes up. And so what that essentially means is that when the underlying, in this case, if we're looking at Tesla here, the market maker short 100 calls. In this example, it's a 50 delta option, which means they have to buy 50 shares for every call they sell. That's their initial hedge, right? In this case, it's 5 million shares. So that's your initial hedge. But as soon as the stock price starts to go up, you have to buy more shares of stock in addition to that, in this case, 5 million shares that you already bought. And so the result is obviously that when they're big enough and you're buying enough shares, you're pushing up the price yourself, right? So it becomes this reflexive feedback loop because the more shares you buy, the more you push the stock up, which means that you have to buy even more shares of stock to maintain your hedges. And so this is the essence of the squeeze. And this is something that we've really seen in Tesla over the past week. You also see in Palantir, as well as some of the Bitcoin names, which are just going kind of bananas as well. So, this is a feature of markets that is really pertinent in the current environment.
What ends something like this? I mean, obviously these things go on. With GameStop, we saw something go on for a lot longer than we thought it would. But what leads to one of these things finally ending?
Yeah, so in this chart, you can see here is that, we're buying calls, the dealers short the call, and they have to buy the underlying stock, so they're trading with the market. There becomes a certain point in time where, and the market makers are better at this now, they move the price of calls to such a level that they become objectively expensive, right? Meaning that even if you buy the call, the odds of that call paying off because you paid so much for it decreases, right? So let's give you an example. If I say, hey, Jack, do you want to buy a stock's at 350 right now, let's say, right? 325. Hey, Jack, do you want to buy a 400 call? And you say yes. And I say, it's $1. You say, great, I'll buy that call right away. But if I go to you and say, hey, Jack, do you want to buy that 400 call, the same one, it's now $100, you're probably going to say no, right? Because the odds of you making money on that call have dropped significantly. Right? It's just not worth the risk anymore. And so what that does when they raise the prices of the calls to extreme levels, it does a few things. Number one, it incentivizes call selling, which either if you own the call, right, and you say, oh, they're going to sell this, I could sell this for $100 now, good, I'm out. Or you want to short that call, right, because it's just so expensive that you want to short that call option. And the way that we can see this is through what's called skew, or the prices of an implied volatility of options. When it gets very high, that could be a sign that this is going to tip over. Because again, once those calls get really expensive, that drives up the buying, and it starts to incentivize sellers, and that kind of turns the momentum of the stock the other way.
And I think you're looking at this a little bit in the next slide. You're looking at implied volatility, you're looking at time, and you're looking at how all that impacts everything.
Yeah, that's exactly right. So in this case, here's a standard delta curve for a 60 strike call option. And what you see is that, again, in this case, if you were to buy when the stock is at 60, you can see that's a 50 delta option. That's 50 shares. And remember before I said if the stock goes up, you got to buy more shares. Well, that's why this delta curve is going higher, right? Because at 65, the delta of this particular option goes to 65. So what does that mean? Well, I had a 50 delta before. Now my delta is 65. I had about 15 shares, right, to make up for that difference. And then so that is the squeeze part, or the squeeze component. And then on the right chart here, you can just see that as implied volatility shifts, so as options demand increases or decreases, that changes the hedging profile as well. That can dictate, so some people would refer to this as Vanna flow. As implied volatility goes up and down, that increases the number of shares that have to be bought and sold. And then the last one here also is time. As time shifts, that can also dictate the number of shares that have to be bought and sold as well. So if you think about Tesla in the context of this week, it's options expiration week, and there's a lot of positions expiring at Tesla. So Tesla implied volatility is currently very high. So look at this out of the money option. Remember, the stock's at 60, in this case in the implied volatility chart. If implied volatility is 40% for that Tesla call, and all that happens is implied vol goes from 40 to 20, you can see that delta decreases, right? So that infers that dealers would have to reduce their long position, their long hedge position, because that delta is dropping. So that gives you an example of how a decrease in implied vol can start to lead to sellers. And then the second one here is time. It's the same thing here, where you see out of the money options, as we move closer to expiration, those options lose delta. So an option with 6 months of expiration has 25 delta. That same option at the same price, so all else equal, when there's only a month to expiration, that option delta goes from, again, 35 down to about 5. So that's kind of the charm or time decay aspect. And so, this all sounds rather complicated, but what it allows us to do is we can map out dealer positioning in the current position, right, what they currently have on, and then say, what happens if implied vol shifts? What happens as time decays or moves on? How those hedging flows set to shift and adjust? And so you get extreme market environments like this, where Tesla implied vol is extremely elevated, as we're going to show in our presentation. And you just say, look, odds are that this is not sustainable. And so this is likely to reverse. And then we can map out, using these metrics that you see on your screen here, how those flows may drive the underlying price.
And we're going to get into this later as well, but this works as well with the election, right? The idea of options flows, because we have a lot of people hedging something like an election. You and I just interviewed Chris Sidiel, and he was talking about what he was seeing behind the scenes. And we had a bunch of people hedging this election, and then that event passes, and we don't get the crazy negative outcome people are hedging for, then these flows drive the whole market up. Is that right?
That's exactly right. And so we mentioned the idea of VANA as a market flow. And when volatility drops, just take the VIX. When the VIX goes from 20 to 14, that is, in a simplified version, that means that stock buyers are going to come out. And why is that? So let's take this chart as an example. Yeah, as you can see here, stocks at 60, right? But look at the out of the money put, right? The 50 strike put. When the put implied vol is at 40, the delta of that put is 10, which means that if I'm the market maker and I'm short that put because I sold it to you, Jack, you're hedging the election, I need to have short 10 shares to hedge my position. Well, the minute that the election comes out and implied vol drops, so in this case, it goes to where the green line is, that's 20%. That means I don't need any deltas up to hedge that position anymore. So what do? I buy back 10 shares of stock. And so when you think that, hey, there's millions of put contracts on right now, and we just take implied vol and we smash it, what does that mean? Well, you can see here, that means that their stock hedges to buy as a result of just implied volatility dropping, right? Not as a bullish expression of Trump, not as anything else, just the fact that we no longer need to be so short as market hedgers, as options hedgers, and we can start to buy underlying stocks, which moves the market higher. And then obviously, if you move the market higher, put values decrease as well, right? Because that's a negative deltas that you can then cover as a result of the market going higher. So again, that's a reflexive loop, but you can, we refer to it as this kind of VANA flow, this driver of market flows due to changes of implied volatility.
Yeah, I mean, this was really eye-opening for me when I realized this, because you sort of see with a lot of these elections, people are panicked. People are worried about something. And we've seen it, I think, 3 straight elections in a row now for various reasons. And every single time we rallied, post-election. All that stuff came off, and we rallied.
Yeah, and we have a bunch of charts that will detail exactly how implied vol, shifted after the election. But if you just take, I know there's a lot of complicated terms and frameworks in here, but if you just say, hey, look, if the VIX goes from 10, to 15, well, that means the market's probably going to go down, right? And there's flows associated with that. And then the reverse way, if the VIX, like it did, it went from 20 to 14, guess what? Stock market's probably going up. And that's a result of flows, right? Nothing fundamental about it, just flows. And the bigger the options market gets, right, the more this volume increases, the more hedging flows associated with all this. And so the more impactful, these hedging flows become.
And one of the things we always talk about on the podcast is it's not just elections or the Fed or these other events, but we also have these expirations.
Yeah.
And these expirations, when we have these types of things going on, something like Tesla, these expirations can play a big role in what goes on going forward.
That's exactly right. And it ties into these fundamental examples we gave here. Because there's time decay, right, which shifts hedging profiles. There's changing positions around big expirations. Gamma increases as we get closer to expiration, for example. So there's a lot of, again, sort of modeling behind this that just shows us that these options flows really start to grab hold into big expirations, and the third Friday of each month is really the biggest expirations. And so the idea here is that there's a cycle. When we get into options expiration, which is where we're approaching here for Friday, that is where the maximum positions are, right? So positions are at their biggest, gamma is at its highest, and then what happens after options expiration? The contracts expire, positions are reduced, associated hedges are covered, and then we start the next cycle, in this case into December, right? And that is what we refer to as the OpEx cycle, and you can see that in price movement in some of the statistics that we have here, that this can be impactful to the way the underlyings shift.
Yeah, this next slide really shows that, right? It shows some of these expirations were major turning points. And it seems like whenever the market's moving in one direction and everybody gets on that side of the boat, you have more odds of a turning point.
Yeah, that's exactly right. And so, the cleanest, most indisputable moments had been during large drawdowns. And that's because the S&P volatility gets to its highest point when the market's crashing. Put positions get to their largest size when the markets are crashing. And so, those mark literally, the day two, the biggest drawdowns that we've had over the last 5 or 6 years. In this case, March of 2020, December 2018, September of 2023. I mean, you can go through the list of major lows. And there's been some significant highs as well. I think, you look at this chart and you say, hey, there's a lot of redexes on here, but not all options expirations are massive, right? Not all of them are impactful. So to your point, when you really stretch vol and you really build massive positions, that's when you really see major turning points.
And as we look at the current expiration, I saw you posted this on Twitter that 6,000 was a big number.
Yeah, this is beast mode here. This strike has about $700 or $800 million in what I call absolute gamma. So let's just take the amount of open interest and you say how much gamma is that? You don't net positions at all, and this is what you see here is that there's this giant, massive level at 600. This 600 spider calls are also bigger, so that's around 6,015 in spider equivalent or SPX equivalent. And this is just a source of hedging flows, right? I mentioned gamma's highs for at the money. Gamma also increases as we get closer to expiration. So what does that mean? Well, that means that if we're anywhere near the 6,000 strike over the coming days, that 6,000 strike just becomes a bigger magnet, right? It becomes more of a source of hedging flows. And to that point, we had an SPX low today of 56.60, and the market very quickly in the next 10 minutes just rallied right back to this 6,000 level, right? So it becomes like this, magnet area for flows into Friday. And then on Friday, we're going to lose about a third of this position, which kind of untethers the market to this strike.
So to 6,000, once we break through it, does it become like a significant support for the market on the downside?
Yeah, so the way that I look at this is that you have these big levels, right? That will, once we get kind of to the upside of them, they become these support levels that are baselines, right, for the market to move forward. And so you can see there are previous baselines here, right? 5,900, 5,950, et cetera. And so the market naturally works above those. This is what we call a positive gamma environment, where those positions create buyers if the market dips down to those levels, right? So if we dip down to 5,950, this positive gamma flow that we're monitoring here dictates that market makers probably have to buy that dip, right? Or they're going to continue to buy that dip until we get to 6,000 and then they stop. So eventually, as we work above 6,000, right, into the 60-50 area, for example, there's a big position there. Those market maker flows will start aggressively being buyers at the 6,000 strike, right? So the level at which they become aggressive buyers continues to sort of slide higher as the market works higher. So the result here is that we're in a very positive gamma environment. I have to update my little arrow here, but we're somewhere north of 1.5, closer to 2 on this chart at the moment. And what this basically shows you is the forward one-day return is on the left axis here. We call this volatility, and then on the x-axis is our gamma index. So the more positive gamma we get, the tighter the returns are. As you can see, that dispersion of the return really kind of shrinks, right? We just don't move much when we have a lot of positive gamma. So what's going to happen here in theory is that we go through options expiration. We're going to lose about a third of the positive gamma position in the market, which means that we slide to the left on this gamma index, right? And in this, around this yellow arrow, you can see that we're getting a little bit more volatility there. So that's kind of the setup for next week, right? That we're going to lose or unclench from this current 6,000 area, and that will allow the market to start to shift a little bit more.
And how major is this OpEx? I mean, it's not a quarterly, right? We've got the next one coming up in December. That's going to be bigger. Right?
Yeah, it's not a quarterly expiration. It's a little bit smaller than, it's certainly smaller than December. It's about a quarter to a third of September options expiration. So it's a very average monthly expiration.
And is December like always the biggest of the quarterlies because it's the end of the year, or is that not really true?
Indeed, yeah. It's always the biggest options expiration. There's a lot of end-of-year positions that expire there. And so, it often means a lot to the market. And then it's always followed by the JP Morgan collar position, which, that dominated September, for example. So that, just adds a little more attention to that time frame. That comes up at the very end of this end of year, right? The 12/31 or 12/30 expiration. We call that the quarterly expiration, the official quarterly expiration.
So in this next slide, you're looking at the price action as we go through the different OpExes and the VIX expirations moving through the year.
Yeah, so statistically, if you look at what happens after expiration, 68% of the time the market changes direction. So if we rally into an options expiration, 68% of the time we reverse after the expiration, or if we're dropping into expiration, 68% of the time we'll change and we'll start to rally, right? So the 68% is we sort of flip the sign on the market direction. In this case, VIX expiration is after OpEx, and what you can see is that changes the odds. It makes it almost more 50-50 if we're going to get, our odds are still with you that we get a flip at 58%. But because VIX expiration is after, that directional change signal isn't quite as strong. I will also note that into this expiration, we have Nvidia earnings on the 20th. And that's clearly going to be a very major driver of direction, I think, at the year end. So the odds of us having a performance flip, a sign change, right, on direction, I think, into this expiration is kind of more of a coin toss than what we normally get.
On this next one, we're actually seeing this in terms of playing through the different options expirations and the different VIX expirations we've seen in the last few months.
Yeah, and what you really, I think, want to take note of here is that there's a lot of volatility into these expirations, right? And then after the expiration, there's this period of cleaning out. That's really what I noticed over these last several expirations, where you get these events where we almost rally into the expiration, and then kind of like, again, the market sort of consolidates for a while, and into the next expiration we rally, and then we consolidate for a while, and then we just kind of rinse and repeat. And so again, we've rallied sharply, 3-4%, depending on the index you look at, after expiration, after the election and after FOMC. We're now consolidating. We're going to move through expiration, and then between VIX expiration and Nvidia earnings, we're likely to get the next catalyst for movement towards the end of the month.
And in this next slide, with implied volatility, we see what we were talking about before, which is people were hedging the election.
Yeah, into the election, as you can see on this chart, this view was from October, and you could see the implied volatility bump or jump due to the election and FOMC, right? And so, that event vol premium was very obvious. You could see it in charts like this of term structure. A lot of people in my space were talking about the possibility of, hey, if we get a clean election, vol gets crushed and the market should rally. I remember talking to Chris before, and you said that, hey, if we know what the results of the election are, then the market should rally tomorrow. And I was like joking, I didn't think that the rally would be, so one-sided. And so, it was called the night of, right? I didn't think that was going to happen. And when that happened, as we're going to show you, vol just got smoked. And that, of course, we think led to these bullish options flows. So, it was obvious that the election was there. The event vol premium, it was obvious that was there too. And so once we got a decisive election and Powell basically just saying nothing, that vol really got crushed.
So on the next slide, we're looking at the November OpEx again, and we're looking at 6,000 again.
Yeah, and this chart is from the October expiration period, and we flagged this 6,000 level. We said, look, if there's upside, this is the level you want to watch because it is going to be so large. So this level, remember, gamma is highest for at the money options. So during our ops conversation, we were closer to the 5,900 level, maybe a little bit below that, right? And so what happens now is you slide up, right, as the S&P rallies and 6,000 becomes the at the money option, that gamma increases. So, this chart really is these positions are very similar from an open interest sign, but when we get to the at the money position, you can see that 6,000 strike is again so dominant as a level. And so, for us, it's no coincidence that we had the rally and we stuck at this spot. Again, S&P is rated 6,000 as we're talking here on Tuesday.
I think this next one is one you definitely got right, which is talking about how Nvidia calls last month were cheap.
Yeah, and it's just so, and this is January skew. So this was not a short dated view. And we were just really pounding the table on this because you didn't know we believe that if there was a clean election and the Powell odds are that Powell's not going to say anything to upset the equity market, right? It just doesn't usually happen. So that event vol contracts, which leads to a market rally. That's just the playbook. And so when you look at Nvidia, which is, I haven't checked recently. It's been flickering back, day to day, but I think Nvidia is the largest stock in the world right now. If it's not, it's top 3. And so you have the number 1 stock in the world having almost no bid to the volatility, right? There's no positioning for calls at the time into the election. And so it just didn't make sense for us at all. And we now, as we're going to show you, this picture has changed. Nvidia's rallied, pretty well. It's not gone Tesla crazy, but it's had a pretty healthy return. And so this view has worked out pretty well. And I think the upside, the big thing here is like, look, sometimes you just find the cheapest way to express an idea, right? You don't know if the market's going to go up, but you find the cheapest way to express the market going up. And this turned out to work out pretty well for people listening to Spot Hammer.
And the last thing you point out as we look back at what we looked at in last episode is this idea of the election twist.
Yeah, and the funny thing here was that the twist was occurring into October expiration. So it's almost like the market was sniffing out the Trump win, ahead of time. And so what you're seeing here is 1 month options. So this was 11/15 expiration from 10/1. You can see there's a big bid to puts, right? This downside. And then by the time that we got to our OpEx conversation, which was mid-October, you could see that put wing started to decrease and the call wing started to increase. See that? So this was this twist was telling us that people were starting to sell puts in favor of buying calls. And in hindsight, say, hey, people are sniffing out the Trump trade. I think that's kind of what was happening. Those people could have been very wrong if, we got a different outcome, obviously. But this twist or this rotation has really continued now, right? Puts are continuing to get sold. Calls are continuing to be bought. And that's really what we're seeing as the major setup here into the end of the year.
It's interesting when you talk about the market sniffing it out. I mean, the prediction markets did too. It's like the places where people were betting money got this election right. I remember like Nate Silver, like a lot of the people, polls and the people running these models. I mean, Nate Silver was like, I remember he tweeted like it was a dead 50-50 the night before the election. Like he had no idea which way it was going to go, and it ended up being very one-sided. So in this case, like the prediction markets, the market, they got it right, and a lot of viewers didn't.
Yeah, and Nate Silver was famous for screwing up the first Trump election, right?
Yes, that's correct.
And so I'm just sort of beside myself. And the thing is, the guy gets a ton of engagement, and it just wastes a lot of everyone's time with this stuff. So it's crazy. But to your point, people put money where they have the most conviction, and so I think you could poll somebody. It's like that French trader, right? He was saying that they looked at these neighbor polls, right? Where if I ask you, Jack, who you're going to vote for, you're going to be a little bashful saying, who you want to vote for. But if I go, hey, Jack, who do you think your neighbor's going to vote for? And you'd be like, oh, that guy's definitely a MAGA guy. That means that you're actually, I don't know if you are, I'm just saying this to, I have no idea if you're a MAGA person, so don't give Jack an angry email. That's just the example, right? He found out from the neighbor polls that that's super interesting, right? And he put a bunch of money where his mouth is on that view, and apparently he's doing pretty well.
This has been kind of a phenomenon, I think, because to some degree, people don't want to admit in polls they were voting for Trump. And so he's always outperformed his polls. So like you think they would have adjusted somehow in the polls for this, but I guess they really can't do that. But it's been interesting. Like he's consistently throughout his time here like outperformed what his polls looked like.
Yeah. And there's a large stapling bias, I think, with that stuff and the other thing. And so, I think that what's interesting about Wall Street just in general is a lot of times people will say, like, how's the market not going down more to this war, right? Or this bombs just went off, and how are people not selling stocks? And it's like, I think there's so much truth in that price action, right? Where is this really a bad event? Well, people aren't buying puts anymore. So, they don't think so. And that's kind of the sum of all fears in some ways. And so, I think the more money that flows around this stuff, you can generally get a better barometer for things than just surveys.
Yeah. So as we switch to our what has moved section here, you're highlighting a point you highlighted earlier in the podcast, which is the vol was crushed.
VIX dropped from 20 to 14 in the matter of 2 days. It actually got crushed before the FOMC. I didn't think we were going to get so crushed ahead of the FOMC. We also put on here the skew index from the STIBO. That absolutely tanked. That's that dark red line. And then the VVIX, which measures the value of essentially out of the money VIX calls, pounded, right? And so, vol immediately got sold. That is the strongest theme that I take out of this market, as we're going to show in a few slides, that people are pricing in like zero risk going forward. And so I think that is a really important thing for people to understand as we approach the end of the year, that, this is a market that is not wanting to go down. You get quasi credit crises or big geopolitical conflicts, right? And that tremors the market a little bit. But in this environment, there's just no demand for hedges at all. And we'll show what we think is reasonable here, but that's really the big takeaway here is this is a market pricing zero risk.
And what was interesting to me is, like, I was thinking when we interviewed Chris Sidiel, I was thinking like, all right, 2 elections in a row, people were hedging, the market ends up rallying after. I'm like, aren't people going to figure out this playbook and it's not going to rally this time, even though people are hedging? And Chris said, no, it's going to rally anyway. Even though people know it's coming, it's still going to rally. And that just surprised me. Like, I figure out, like, when people figure this stuff out, eventually maybe it stops happening.
And I think that's the thing with events, right? Is that we all believe that the market's going to rally out of the Trump and FOMC, out of the election and FOMC. And maybe even the people who have on the positions know that, but they can't remove the hedge before the event, right? Like, you own the event hedge. That's what you own. You can't close it before that. And so, that event triggers, and the benign passing of those events, triggers these flows. And so, unfortunately, even though we all think, well, why don't you just sort of front run this move? you can't necessarily do it, right? Because you're hedging this event, not necessarily an idea or a risk, right? Like you can't always say, hey, with Iran and Israel are passing missiles back and forth, and I don't know, I just don't think it's that big of a deal, so I'm going to short it tonight, right? It's not like at 3 o'clock, if 3 o'clock tomorrow passes, then there's no more bonds going off. So with the elections and again the FOMC, like you got to own the hedges to the event, and then as soon as the event is gone, then you can crush that ball and the market can catch a bid.
So in this next slide, you get at what you talked about before, which is the high risk stuff's been moving.
Yeah, Bitcoin. I mean, this chart doesn't really do Bitcoin justice, as everything's on a percent scale. Bitcoin went from 70, 75, something like that, up to we touched 90 yesterday. So that's up 25% since the election. Tesla is number one at the moment, shockingly, 35% roughly we're up. But if you look at the spiders, spiders up about 3%, which that's a healthy rally for 3-4 days. Don't get me wrong. But I think when you talk to people, they're like, oh, this is just uber bullish environment right now. And it's a 3% rally, which, I don't think is statistically that much of an aberration. And so, yes, we're at all-time highs, and yes, the market's up 50% this year, which is, astounding. But it doesn't have this overbought quality that I would argue like Tesla does in the short term or Bitcoin does in the short term. So I think there is plenty more upside from the metrics that I'm looking at. And then I also just thought it was funny, we went to the Bobby Kennedy kind of cleaning up our food system. General Mills as a proxy for that's down nearly 7% as America, is going to struggle with this junk food diet here. It's pretty fun to watch that as a Trump theme go down.
And that was something I noticed, like particularly the day after the election. I think you're getting at this in the next slide, is this idea that a lot of stuff was up a ton the day after the election, but a lot of stuff was down a ton too. It was really like I noticed home builders got killed like the day after the election. People were really, it was the Trump trade. People were figuring out what's going to benefit here and what's not going to benefit.
Yeah, people I think are maybe jumping the ship, extrapolating, what the policies are going to mean, right? I mean, he's only now picking cabinet people. There's a long way to go. I've been talking about how people were, flagging this Mitch McConnell having a Senate vote or whatever it is tomorrow. And he's going to try to call him this anti-Trump guy, and that's going to throw a wrench into his plan. So there's still so much that can happen between now and whoever, whatever happens into January, and then whatever policies Trump is able to, enact and get support on, right? So there's just so much there, and this is the flows over fundamentals thing, right? Where people are piling into those trades and then just saying this is going to go up because it's going up, which is kind of I think about what is happening with Bitcoin and Tesla. And then in here, the other thing that catches my eye is TLTs, which is purple. That's the long bond ETF, right? That has now gone inversely correlated to the market. There was a good while here from August, September, October, where the long bond was moving in correlation, right? Positively correlated with the equity market, which was very unusual. And now after Powell sort of said, no, we're on pace for cutting rates, the long bond has started to act more kind of inversely correlated to the market, which I think, is the 60-40 portfolio. So some of these relationships are normalizing, but the big thing was we talked about the Nvidia industrial complex, right? Nvidia being red here. And remember how Nvidia was becoming uncorrelated because it was going up so much to the rest of the market. Tesla seems to be taking that position. That's one of the big themes here is that, with Elon apparently he's having daily lunches with Elon or with Trump, and he's having phone calls with Zelensky and stuff. And I don't know what that means for Tesla stock, but it does sort of if you want to buy Elon Musk, you kind of just buy Tesla stock is sort of the meme here, right? And a lot of people are in on that trade at the moment, and it's again seems stretched, but it's also gotten uncorrelated with the market in a major way.
Yeah, and as much as I have mixed feelings about Musk, you have to say like he played this election from the perspective of his personal businesses about as well as you could possibly play it. I mean, he got on Team Trump, and now he's like everything he's involved in is just going up like crazy.
Yeah, there's absolutely no doubt about that, and I'm with you in a lot of those ways that I don't know how I feel about him, but I think that we all would agree that the previous administration was not helpful to Tesla as an entity. They clearly had a contentious relationship. And so even if just now, there's a better working relationship with the government, then that has to be a positive for Tesla. But again, I'm not a fundamental analysis. I don't know. I just know that when you start buying, millions and millions and millions of calls, stock's probably going to go up, and that's the play.
Yeah, and this next slide is about Tesla. And you're talking about this ludicrous mode we've been in.
Yeah, and we put this out on the 7th, and this was the idea of flows over fundamentals, and that the market knew that if Trump won, Tesla should go up. And so the result of that, as you can see, this is from November 7th. We actually wrote this the morning of the election, that there was a call skew. So this orange line, the teal line, is 1 month options. And so you can see that the out of the money calls, which is where my cursor is here, they had a higher implied volatility than the at the money calls. And that generally only happens where people have a pretty bullish view of the stock, right? And that is, I would say, a healthy bullish view, because you see this cone here, Jack, that we're at the bottom of this cone, which tells us that overall implied volatility is not that high. So yes, there's relative demand for calls, but the options arguably aren't super expensive. I'm going to show you, and I think in my next slide, this is what Tesla's skew looks like now on a 1 month basis. And you can see that we're all the way through that shaded cone, right? And there's a tremendous bid for calls relative to the at the money options. So again, if you compare this apples to apples, the look of these two positions, what we were talking about in the 7th is that, yes, Jack, you know that Tesla should go up if Trump wins, but what you're probably not pricing in is the gamma effects, right? The chase or the FOMO effect of this, which will exacerbate volatility. What does that mean? That means the stock is going to go up, and as it goes up, market makers have to buy more, and that makes the stock go up faster. And then the result is you get, instead of a 10-15% rally, you get a 25-30% rally.
So in that second slide, are we starting to see the signs that this Tesla thing could be starting to come to an end?
In the short term, we're very overbought, and this harkens back to the start of our conversation where I was saying, "Hey, Jack, if I sell you a 400 strike call for $100, you're going to say, no way, I got to sell that." Well, we're kind of in that zone of, okay, the 400 strike calls aren't $100, but they're very expensive, and so the problem is you buy that call, the probability that it goes in the money is much lower now, right? Because Tesla stock could continue to go up. But if it's not going up at the 5-6% that the market is pricing each day, this call needs a 5% or 6% daily rally for this call to pay off, right? And the odds of that happening are very small. And so what happens is that value of that call needs to drop, and that brings flows, which pressures the market down. In this situation here, we have a big options expiration for Tesla that makes some sticky levels for the name. That call buying is stopping. The momentum in the stock is stalling out. And so this ball is going to correct pretty quickly, and that's bringing some selling pressure for this week. But I think it's just a consolidation phase for the stock. I don't think the top is in.
So on this next slide, as we look at what to watch in November, you're talking about Tesla again. And I wanted to ask about this because this gets back at the idea we were talking about before, which is, when you've got everybody on one side of the boat and the market's moving that side of the boat to an expiration, you can get a reversal. But I think you're saying, you don't expect a significant reversal here in Tesla.
Yeah, I mean, significant is relative, right? The stock is up 30-35% into Friday, right? And on Friday, we had record call volume. You can see in this chart, we had just unbelievable amounts of calls trading. And so you go from Friday where there's 4.8 million calls at the second highest ever, then the weekend hits, right? That generally stalls momentum. The stock on Monday morning was in the 350, 360 area. Now we're down to about 328. There's a huge amount of positions at 300, so I don't think we go below that area. But the stock is definitely giving some back to 10 or 15%. So, there's a path dependency here. And what we generally need is call options to values to come down to make them more sensible for people to buy back in. And so this options expiration gives that cooling period, I think, for the stock in order for it to sort of rebase. Because this reminds me a lot of Nvidia, where we kept saying, this stock has got to stop at some point. But every time the options prices would come in a little bit, people would start bidding the calls up, right? They start buying the weeklies again, and the thing would just continue to kind of ramp. And so, this is the path, right? This is meme number one. Elon is the number one guy in the world right now. And so, if you want the manifestation or the archetype of the Trump trade, it's Elon Musk and it's Tesla. And so that's why I think that there's a huge level at 300. I still think, as we're going to talk about in a minute here, that we reach 400 because these options flows are going to continue to be a major driver over the medium term, right, over the next couple of months.
So in this next slide, we get the idea. Elon's here. I guess Cathie, I didn't even know what Cathie's been up to, but I'm sure it's she's been up to no good.
Cathie Wood disappeared on us, right? And I always found this very agitating because she loses a bunch of money for people, and then she'd be on like all the media every day, and I couldn't quite understand that. But what's interesting here is that ARK is a very large holder of Tesla stock, and so ARK is now up 6%, I think, last week as a result of Tesla popping, right? And then Elon was retweeting Cathie Wood this morning. And so I was like, okay, these are two of the archetypes of the meme trade from 2021. And the only thing we're missing right now is a roaring kitty appearance. If he comes back, then we have the full kind of 2021 mania. And 2021 was just an unbelievable market movement, if you remember that year, right? Meme mania was just going crazy. The markets were just going crazy. And I think that when you look at valuations now, people go, this can't get crazier. And then when I look at these three people and I go, yes, it can. We have a lot of reasons to think there's more in the tank here.
I mean, it almost seems like the kitty has to get involved, right? With what's going on right now, like it would be out of place for him if he doesn't get involved here at some point.
I totally agree with you, and he had pivoted to, I don't know if he pivoted to Chewy. I think he did. GameStop has not necessarily caught a bid, but this is the thing, if you look at Tesla, it was the original meme. And I say that, it was having this call options volume cresting in 2020, like before Roaring Kitty was even a thing, right? And I think Elon Musk knew that. He's made some jokes about, black shoals before, not being a great, I think it was a great equation. He made some kind of a joke about that. It just kind of makes you believe that he sort of understood the power of this a little bit. And I think he was paid out in options and he was attacking shorts. And I think he was really able to squeeze Tesla to be in the S&P 500. It peaked right after it was in the S&P 500. And so, he's the OG, of the meme mania. And I think it'll be interesting if Roaring Kitty sticks with the GameStop theme or if he starts pumping something new. But if he started pumping Tesla, then you got to start to watch out. Could happen. Maybe that'd be my prediction.
I do wonder to some degree if he's lost his powers a little bit because, the whole live stream didn't go well.
It was horrible. Talk about a loss of event ball, right?
Yeah.
Yeah.
So I wonder if next time he does it, if anyone's going to care. We'll find out, I guess.
Yeah. We will find out, right? That is for sure. That was a real waste of time and energy and a flop and excitement. GameStop, it's up $26. So it's done okay recently, but certainly not a Tesla move. So here we're looking at the current positions. This is 340 and 350 are these two big strikes in the middle. Tesla's really kind of rotating around that level. A lot of those positions are going to expire at this expiration, about half of these positions. And so what you start to look at here is this 400 strike. There are big positions up there that are out in December and January. And then you also have, yes, the implied volatility is very rich right now, but that can revert very quickly, right? So by the end of this week, we could be in this 300 to 325 area. This is 300. It's a very big level for Tesla. And I think that could be, hey, we consolidated, that vol came down, and then we could really start to re-rally next week. And there's room now for call buyers to come in because those calls aren't so expensive, and that can kind of re-energize things. The other thing that's interesting about 400 is that's the all-time high in the stock that was, again, late 2021. And so, that is certainly when you talk about, technicals or whatever, that's certainly a level that people are going to be watching. That's about 20% now from where we're trading at the moment. So that's certainly achievable in the short term. And that's something that I'm really watching here into the end of the year. And this could be a stock where, again, you hearken to this idea, or you turn back to this idea of the Nvidia industrial complex, where there's a lot of ETFs that hold in Tesla shares, right? Tesla's not as big in the S&P 500 and the NASDAQ as Nvidia is, but it still has plenty of sort of offshoots, right? Like ARK and like these other funds that if Tesla goes up, they'll be buyers. And so, there's plenty of fuel in addition to the call options complex to move this thing higher. So, from flows over fundamentals perspective, I think that this has a lot more legs.
Yeah, and the next slide gets at what you were alluding to before, which is ARK's been running. I mean, I was looking at, it's one of my proxies I use just to see on my dashboard, to see what certain parts of the market are doing. And it was up like 7% plus the other day.
Yeah,
so it's really been rolling.
Yeah, it's really amazing. And I think that, when Tesla implied vol gets crazy or a little too much, or you want to invest in the Tesla trade, but the calls are too expensive, you can turn to something like ARK, where the implied vol will be lower, and that they need to buy up Nvidia shares. So it's sort of like using SMH as a proxy for Nvidia back when the Nvidia vol seemed like it was getting a little too high. And actually, we're going to talk about that in a few moments. But ARK is really an interesting basket to buy, if you do want some exposure to Tesla, even though I think a lot of the other instruments in there are maybe questionable, and Cathie Wood is a little bit questionable from her, background. But if she just owns a bunch of Tesla and Tesla's going up, then, we'll see what happens.
Does ARK have like a pretty active options complex?
It has a very robust options complex. Yeah. So there's a lot of liquidity there, and you could definitely get access to options in that space for reasonable prices.
So in this next slide, you're getting at what we're seeing, which is nobody wants the puts right now.
Right. And so we showed the skew rotation into the expiration, but this is Apple 1 month expiration. You can see here from 11/4. So this is the Monday before expiration. This is the gray line. Vol has dropped. That's the whole surface dropping to where we are now, which is teal. But that put wing has lost a lot more value. The implied vols dropped a lot more relative to the call side, right? So this is the idea. People do not care about downside anymore whatsoever. There's a little bit of a relative bit to calls, but the calls, in my view, they're not like overdone, right? This is not everybody loading up the truck. So the memes are memeing right now, but people have not yet bought in, I don't think, to the index or the kind of Mag 7 names, right? Ex Tesla looking to go higher. So if you look at Google or Meta, Amazon, the skews all look like this, right? They haven't started to really, they're simmering, which is what you want to see if you're looking at the options floors as a bullish signal, but they're not yet shifting to this kind of overbought territory at all. Plenty of room for these things to get bid up, in my view. And I think when we see consolidation here, this consolidation is being driven by people monetizing upside positions right now, as opposed to saying, hey, I'm really worried about the future, right? We're seeing call selling right now, which is taking money off the table versus I want to buy puts because I think the market's about to crash. And those flows have those, that matters, right? Because if you're buying puts, that has a lot more downside momentum than selling calls as a function of hedging flows.
Yeah, one of the things I've learned in my life is whenever Jack is like a contrary indicator on this. So whenever I think, oh, this thing can't go on any longer about pretty much anything, it always goes on longer. So always in the background, the narrator is like, and it did go on longer. I think that's like, this will probably be the same thing. Like I'm never involved in these types of stocks anyway, but it probably will go on longer than people think.
And I think, you highlight this thing that's so important about the options market is that we spend a lot of time just talking about the flows, and that's what I focus on. But when you learn to trade options, and I think there's a lot of funds or people in your space maybe that don't look at options positions, you could set up all sorts of structures to take advantage of this stuff, right? So if like, hey, I don't want to reduce my participation in this, I still want some upside, but I got to take some money off the table. We saw a lot of Tesla stock replacement trades, for example, where they would sell their shares and buy a bunch of January calls. You could do all sorts of ratio spreads that still give you access to the upside, but take a lot of the risk off the table. So that's what's kind of fun about the options positioning is that you can still get that upside exposure if you want, but you can take some off the table and really dial in how you want to express views, and that's what's so fun oftentimes about analyzing this stuff.
Yeah, well, we won't talk about this now, but it was, as you probably saw, like I had this thing I put from Jem Kersan up on Twitter, this whole idea that like options are not a derivative, they're the underlying, and the idea about how they reflect the full distribution. And I caused like more controversy about this, so I have no opinion either way, but like I caused more controversy than I ever could have with that.
Yeah, it's I mean, he brings up a bunch of interesting points, and anytime you see, I think one of the tricks is that anytime you see people just running into call options, right, as a first order principle, if people are buying calls and we're getting better and better data and information that shows us, okay, they're definitely buying these calls, we could see it happening, and that's going to change the distribution itself because of these underlying flows, right, because of these hedging flows. And so that's kind of what our whole business is based on, this idea that these options flows could be a driver of the underlying. And so, to the point on Tesla here, right? When you're looking at, and we're forecasting Tesla, and you look at this skew, and if you just showed an options practitioner this skew, and you say, what does this look like? You go, looks like people are pretty bullish on the stock, right? So everybody's already prepared for the Tesla trade. And then I go, no, it's not enough, because when people start to buy calls, it's going to shift the distribution because the stock is going to go up a lot more, right? So that call buying is changing the distribution. And so instead of the distribution, distribution arguably should have looked like this into the election if people were really that bullish on Trump and Tesla, right? But it didn't. It looked like this, which had a much lower skew. Implied vols were a lot lower. And so I think the market catches on to this idea, or is catching on to this idea, and that's a pretty interesting thing, right? And it kind of backs a little bit of Jim's point. And I think as the options market grows and continues to mature and traders get more sophisticated, they'll start pricing in the changes to that price distribution.
And on this next slide, we're back to Nvidia, which is still around. Even though everybody's talking about Tesla, Nvidia still exists.
Yes, and so this is the Nvidia term structure. You can see that short dated implied vol. So this is this week's implied vol, very low. And again, there's like a couple of days to expiration, but this elevated term structure is due to earnings. Earnings obviously matter. I don't know that this stock has really missed on earnings. It's like, how many billions did you make here? And the thing that I find so fascinating is, I'm skipping ahead a slide here, is that when you go into earnings, implied volatility lifts for a stock, right? Because everyone knows the event is there. It's just like going to the election. Like, we got to hedge the election. So there's a lot of vol priced in for the Nvidia earnings event for short term, right? And so that term structure is in the center of this cone. So do I want to buy Nvidia options right now to express my idea? No. Last OpEx, that was the time, right? Now the skew is higher. The options are higher because are more expensive, arguably, due to the earnings, right? But I think that if Nvidia earnings are positive, I have no idea, or if the market just takes them as positive, that is absolutely the trigger for the market to start to move, right? Because the one thing that we've not really triggered yet out of this Trump trade has been the semis, and the AI trade is not arguably fired up yet, right? I don't know if that's related to the possibility of tariffs and moving chips around, or if it's just people are too busy trading Tesla. But if we reinvigorate that semiconductor space, then the market's going to start to go up significantly, in my view. And I think that even though Tesla options are very expensive, right, and Palantir options are very expensive, and Bitcoin options are expensive, right, that stuff's all been bid up. When you look at something like this is SMH, right? And we were talking about ARK being a kind of a sister trade to Tesla, right? Or offshoot of Tesla. SMH is the same thing for Nvidia, right? SMH is, I think, 25% Nvidia shares. And this is January call skew. And so you can see here that the shaded cone is 90-day implied vol. Well, implied vol is as low as it's been in the last 90 days. And SMH is not that far off of all-time highs. So if you want to bet on this idea, and I don't know if the market's going to go up, but let's just say you want to hedge out that idea, I think the SMH calls are pretty cheap, right? And I think that when the market starts to move up, these calls should start to move not as extreme as Tesla, because this is an ETF, but it starts to move in that direction, right? The call wing starts to lift and implied volatility starts to lift up a little bit. So what I like about this is that this shows me there's plenty of room for demand to come into this space, right? To bid up these options. And that tells me that, hey, people are not all that bullish. Like, people are saying, look, we're at all-time highs right now. How much more can this go? Well, the options market has not really been showing that bullish activity has been invoked yet, right? And I think before this rally's done, you got to see, these call vols lift and things get a little crazier. At the moment, they just really haven't seemed to express that. So that is really why I think this Nvidia earnings event matters on 11/20, is that this could spark a real rally in the space, and that is, again, such a driver for markets writ large, due to the fact that S&P and NASDAQ are 25%, semis, right, directly related to semis.
And so I think you were getting the same idea in this previous slide, but as part of that, I also want to compliment you on your dashboard, because as a value guy, I don't really get to have dashboards. And this looks really cool. Like, you guys do dashboards about better than anybody. So I have to find some way with my value stocks to have like some sort of dashboard where I can see like stuff moving all day.
Yeah, you just make your Excel cells fish colors.
Like, my stuff is like paint drying, though. It's like it changes so infrequently that it would be like the slowest moving dashboard of all time.
That's really funny. Slow and steady wins the race, though, Jack. This is our trace tool, and what trace shows is real-time dealer positioning for the S&P 500. So we're monitoring where we think dealers are buying and selling calls, right? And so the takeaway from this is that if you look in that box, that is above 6,050. So everybody knows that JP Morgan call-out position is struck for the end of this year at the 60.55 strike. And so there's a bunch of positions. I kind of blocked it out a little bit at 60.55. This is just open interest, right? Above 6,050, there's almost no positions in the market in the S&P 500, right? From the dealer perspective, we have basically dealers holding some short call positions, was what these, some small call positions. But that's really about it, right? And so what this is signaling to us is that if the market starts to rally a little bit, there could be a real spark, right? Because people have to start to reposition or buy into the fact the S&P can move into the 6,100 to 6,200 area, right? They have to position for that. They have not yet positioned for that, in my view. It's similar to SMH, where you look at this call scheme and you go, nobody's prepared for a lot of upside. Yes, they're not bidding up the downside right now, but I think that you have to give edge to this market wanting to go higher, given the Trump trade, just given the fact that for the last 2 years, every dip has been bought. Even though risk has popped its head up, no one ever really buys those puts. We have little spasms in the market re-rally. So if Nvidia is at all bullish or just kind of in line, it shows that demand is still there, then I think the market has to really reprice the odds of the S&P moving up to the 6,100, 6,200 area. That would generate some long call demand that could really squeeze this market higher. And so, my takeaway from this is that based on the Nvidia earnings, if they're bullish, right, then I think you get a risk on move. And I, quite frankly, don't have a great upside target for this, right? I think 61, 6,200 makes sense. What I have is more of a time frame, and the time frame for bullishness is until really December options expiration. I think we'd have a really solid month-long rally into the end of the year. And so, if we're above 6,000, if we hold that level, then it's risk on into December options expiration. We flipped to a little more of a neutral stance. It's murky in this 5,900 to 6,000 level. And if for some reason Nvidia earnings are bad or we break 5,900 for any reason before that, then I think that triggers a much longer kind of risk off move into end of year. But I'm really edging on this rally into the end of the year. And I think that's unique because some people are concerned that the rally maybe has been pulled forward at this moment. But I don't see any froth yet in options pricing for the bulge bracket names, the Mag 7 names, ex Tesla, semis here. I think, expressing an end of year rally via Jan SMH calls makes a lot of sense. And that's kind of the setup that we're seeing here. So, Trump meme mania, I think, is alive and well. It's a little rich in a couple of specific names, but this market overall doesn't appear from the options perspective to yet be overbought, and people just don't have any interest in hedging the downside.
Yeah, it's interesting. You and a bunch of other people on the podcast who follow flows, some option related and some other things, have shaken my belief in Santa Claus, because as much as there is a Santa Claus rally in these up years, what causes it is not exactly Santa Claus. There's structural reasons behind the scenes as to why we have these big up years coming through Thanksgiving. Why, as you mentioned, going into that last expiration, going to the end of the year, there's a good odds of a continuation of that.
Yeah, and in this environment too, there's those flows. I mean, our Jim covers those a lot, and Mike Green, right, passive inflows and all that sort of stuff. And in this case, not only do you have that, you have meme mania, right? I mean, I make a joke about Elon Musk and Cathie Wood, but those are the archetypes of the meme mania, right? And they're front and center now, at least Elon is. And so, I think you have to count that in as well, right? Because when Tesla rallies 30% over 5 days or whatever it was, that added 40 bips to S&P performance, right? So, there's just a reason that when these big stocks start to rally, it drags the market higher. And that's a function of, again, flows, not fundamentals. Like if Nvidia goes up 10, 15, 20%, the S&P is going to get pushed higher as a result of that. And so I think that is, a thing that people maybe discount into the year end.
And whichever way it plays out, you can pretty much guarantee with the big expiration in December, we're going to have a lot to talk about in our next episode.
Yeah, plenty of stuff to talk about, plenty of stuff to trade. So I'll be looking forward to that December conversation. And go check out the interview with Chris Deal. That was a lot of fun, and we got a lot of great feedback on that. So that was great.
Yeah, that was really cool. Thank you for helping me, because I don't know if I could have held that together on my own.
You did amazingly well, and you're a much better interviewer than I am. So we'll anoint you the Vol interviewer from that.
The Vol interviewer. That's a title I've always wanted to go for. Well, that's a good note to wrap up on. Thank you, everybody, for joining us, and we'll see you next time.
Thanks so much, Jack.
This is Justin again. Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.